Okay, got it. So I guess I'm starting. So guys, first of all, thank you very much for having me here. A few words about myself. So I initially started my own company. So I started as an entrepreneur, and at some point I turned to the other side. So after a few years running my own D2C, I joined InReach Ventures as an entrepreneur, and with time, I think within a year or so, I became, I guess, like mentally, a full-time investor. Even though I was, doing my hours anyway, and then doing my own thing during the night. I think after a year or so, I decided that I think it's going to be better if I just focus on one thing. And then I decided to be a VC investor with InReach Ventures. So my background, I guess, initially was very much consumer, but because European ecosystem is very much dominated by SaaS companies, I think over time I have shifted quite a bit. And I think as of today, it's fair to say that you can think of me as SaaS investor, early stage. Why early stage? This is very much connected to InReach Ventures and our investment thesis. We do early stage. We do anything before the typical round A. We run at the moment our second fund, that is 60 million. And we deploy on average 1.2, 1.5 at seed stage. The rounds that we tend to participate are between 3-4 million. And this is something that you're going to probably hear quite a bit from institutional investors. We do have a certain ownership target. And I think for VCs, it's particularly something that they can't negotiate as much. Yes, you will have some investors that may be like Seed Camp, for example. I think these guys do not go below 7%. Most of the VCs out there, they will tend to have 10% as minimum when they syndicate. So when you do your round construction, I think it's something that you have to keep in mind. If you would like to have two investors, two VCs, you have to kind of, think of your dilution. Because one investor will take 10, for example, the other one will take 10. And then on top of that, you might have some business angels, you might have some people that you believe will make a difference for you. And then suddenly your round is getting more and more expensive. By expensive, I mean basically the dilution that you agree to have with the amount that you're fundraising. So I think from the beginning, it probably makes sense to kind of simulate your round. Just, put a very simple cap table with the amount that you are trying to raise and the dilution, and then later on you can kind of exactly simulate the amount that you're gonna get as the final valuation and so on. And I think once you have that numbers in front of you, this is kind of making things easier for you to run the process. But I'm just getting into the details. Going back to InReach, we don't have the investment thesis per se. We're quite agnostic. We would look into many different spaces. We would invest in many different areas. But having said that, I guess you cannot think of us as a VC that does hardware. For example, also like biotech. It's not really who we are. And I guess, in the end of the day, we all try to make a difference. We all try to help you. By we mean investors. And since we haven't done really hardware, we probably wouldn't be the right partner. And in that's why, in most of the cases, we simply kind of say like, no, we just, not the right VC for this sort of businesses. The reason why we, for example, are agnostic is really the way we do the deal flow, and we do that through the tech. that we actually do in-house. The setup that we have is, I would say, like super unconventional with regard to a traditional VC. So normally, you will have the partnership dominated by investors. In our case, one of the partners is actually our CTO, and together with his dev team, he is developing for us a platform that is proactively collecting and analyzing data. So anything that you guys, for example, decided to make publicly available through different APIs, through different scrapers, we try to collect as much data as possible. Then we structure it in-house. We put ML on top, big data analytics, and the platform is surfacing for us companies that potentially fit into our investment strategy. Very often I get the question, what it is that we're looking for. And to be honest, the signals that we have are, how to say it, rather straightforward. So what we were trying to do is really to digitize to digitize an investor, how we look at things and how we connect the dots. So we will have information on the founding team. We will try to understand how complementary is the founding team, what is the background that they have. We will try to figure out if the founders are serial entrepreneurs, if the founders are doing this venture that they have for the first time, what sort of connections they have, when the company was started, how much capital has been invested till now, who are the founders, who are the investors, what else? We will try to also get an idea on the traction that you have with combination to the type of startup you do. Because if you do something commercial, something consumer, then obviously there is a certain expectation that there is like lots of traffic happening. If this is a SaaS business, then obviously that traction, the volume will be slightly smaller. And on top of that, if we, for example, identify that instead of targeting mid-market, your startup is targeting enterprise sale, then obviously that traction, your volume, is probably smaller than anything else. So I guess our algorithm is going definitely through a challenge to really kind of, understand the data and how to say it, process it in the same way as I would do as a human being. What else? When it comes to geography, you should think of us as pan-European. Europe is the area where we would like to deploy our capital. We have some exceptions in US, but there's like maybe 2 or 3 companies that are based there. We would prefer definitely to deploy our cash in Europe. I guess that's it really when it comes to InReach in a nutshell. But if there are some topics that you think I missed or are in kind of particular interest for you, then obviously more than happy to dive into it.
That's a great introduction, Karolina. One thing we haven't discussed yet in the program that you just touched on is ownership. So can we dive into that a little bit more? Because pretty much all the founders in the cohort have already raised their pre-seed. And we know for pre-seed, you're typically giving away between 10 and 20% of your company. So can we talk about, if we assume that for pre-seed with seed, if one investor is going to want around like minimum 7%, what do you see as like the total? How much ownership should you expect to give it away at your pre-seed? And also, what's the typical like valuation that you're seeing? How much do you typically see people raise at seed stage?
Yeah. So sometimes, what we see at pre-seed is that founders, they tend to agree on terms that are quite aggressive. because they are, at the beginning, sometimes they raise 300K, 400K, 500K at the valuation that, as I said, is quite aggressive, and they give away too much equity. So we do like to see the dilution 15% at pre-seed. Sometimes, yes, it happens that it's 20, 25, but then the round itself needs to be quite significant. Recently, I had a startup that was raising at pre-seed 2.5 million, but it was giving away 30%. This is something that maybe I would not recommend immediately. I would maybe recommend to, at pre-seed, raise something smaller and then give away maybe 15%. What's happening at seed? Then normally, these rounds are between, I would say, like the maximum what I see is probably 3 million. So seed should be like 1.5, 2, 3 million. It depends obviously what kind of product you have, in which space you operate, and what are the resources you need for you to actually get into a successful round A. So whatever you actually fundraising as of today, you should always think what it is that I need to get in 18 months to my round A. So this is how I would always approach, the amount. So the next question was about the valuation. That's a little bit a tricky question, to be honest. It's tricky because it's more a bit of an art than a science. Every single round that you guys are going through will probably take away something between 15 and 20%. So you can't really kind of get away from that. Some of these rounds, if you are raising a bit of more cash, will require 25%, because obviously if you have index coming in, or if you have Sequoia, and on top of that you want to have someone else, you are very happy to give 25% or maybe even 30, because these guys, they actually send a signal to the market, and they can make a difference for you because of the network that stands behind. If you have investors that obviously can help you a lot, but some of us won't be as aggressive, and will settle on a dilution that is probably not as aggressive to you as founders. Then in most of the rounds, we will kind of tend to think of 20% as your max. So if you have these two numbers, if you have your dilution that you agreed with investors, if you have the amount that you are trying to raise, with these two numbers, you will have your valuation, not the other way around. Because if you come with your valuation into the market, then sometimes you're optimizing for the wrong thing, because what you want to optimize is very much for the amount that you're raising and for the dilution. You do really need to think how expensive this round will be for you. And then the valuation is something that is basically a factor in the equation. So obviously that's my personal view as an investor. I think it makes sense if you guys do speak with other people how they approach, but I would always advise entrepreneurs, at least at this stage, not to think of valuation as much, rather than optimize for the right people, for the amount that you need, and for the dilution.
Okay. What if for a company that is going, I guess the valuation, if I'm kind of doing rough math here, would be anywhere between like 7 to 12 million as like a ballpark. Can you just give really brief outline on the sort of metrics that you would associate a start? Like, what does a startup need to achieve in order to hit that valuation in terms of MRR, ARR? I know you said you mainly focusing on B2B SaaS, so we could just take like a run-of-the-mill B2B SaaS company. What would that sort of outline look like?
Yeah. So I guess, you guys send me some questions per email about product market fit. And I think at this stage, we do not assume that you have a product market fit. And why? It takes time for you to build the product. It takes time for you to work as a team. So most of these things will happen at pre-seed. Your MVP, it's about, there should be always a bit of an outcome, what it is that I want to achieve with everything that I do. So your MVP is, at least to us at InReach, a proof that you can work as a team and you can deliver a product. So it's going to take time for you. It's going to take time to kind of release it, test it with your initial adopters. If you're lucky, yes, you will have some revenue, but it's going to be probably in most of the cases marginal. If your product, if your runway was long enough and allow you to have like few customers, then it's amazing. At seed stage, I think the ideal number is probably 10K in monthly recurring revenue. This is something that investors do like to see. I think at seed stage, it's very hard to fundraise, especially nowadays, if you are pre-revenue. Yes, it happens because of the specifics that you might have about the space. For example, Figma. I know that this is, like an excellent company nowadays that everyone is using and thinking like it's like a super exciting product and so on, and dominating the space. But Figma, if you check the traction these guys had initially, there was just basically nothing for quite a few years. And then obviously at some point, once the product was ready, these guys got a hockey stick. But why I'm bringing this information is really kind of, I just don't want to generalize things, because yes, it's great to have 10K in monthly recurring revenue. But again, some businesses, some spaces, some products, they do require time. Especially in nowadays when it comes to the infrastructure. Anything around data, anything around machine learning and so on, companies then they tend to operate as open source. And with that, I think at seed stage, it's very difficult to generate a significant monthly recurring revenue. These companies, they will have communities, and this is how we need to judge them. We need to kind of figure out how many people are using it, how big is the community, and so on. So on one hand, yes, it's monthly recurring revenue, but it's also so many different things that you need to take into consideration, like we investors. So I think good investors, we always try to really kind of deep dive and have a really good understanding about, again, the space, the product, and the resources that you guys actually had available at your pre-seed stage. Because if you fundraise, for example, at pre-seed 10 million, you can do probably many different things. And you will be judged differently if someone has been able to bootstrap the business or if someone raised 10 million. So I guess, I don't really have a very clear answer to all of this, because I think it's just quite complicated. There's just so many unknowns, so many different spaces, products, markets, that it's a little bit difficult to kind of, generalize every single thing.
Yeah, that makes sense. If anybody has any specific questions, feel free to use a chat or raise your hand and we'll get to them. Question from me. So there's the difficulty around kind of ascertaining product market fit, but with the algorithm that you mentioned, you talked a lot about the founder and the founding team and whether they're first-time founders or serial founders. And I guess, how important is founder market fit to you / InReach? And when you're talking about founder market fit, do you mean that they have industry experience in the industry they're selling into, or the technical capabilities within their team, previous startup experience, all of the above? And kind of a secondary question to that, if you don't have industry experience, what can you do to prove that you're the right founder to build this business?
Yeah. So when it comes to SaaS businesses, we do pay attention a lot to the technical skills that you guys should have within the founding team. In the end of the day, SaaS businesses are very technical companies. It differs slightly from marketplaces, because with marketplaces, the most important thing you can do is to think of your liquidity. So who do I have on my supply side? Who do I have on my demand side? And how do I meet these guys? I think tech, even though it's important, is probably secondary. With SaaS businesses, it's very different. So for us, it's super important that we can actually identify someone that has this very, very strong tech domain. Normally, one of the founders is probably CTO, or someone that really understands the architecture or technology and is able to actually hire someone that maybe is very strong with tech. But having said all of that, the ideal team, at least for SaaS businesses, is someone that is first of all technical, and then secondly, someone that has that ability to translate the vision into the product. Because in the end of the day, you guys are building businesses. It's not about tech as much. It's not so much about the product. It's about business. We do not invest in technology. We invest again into how you use the tech, how you translate your vision into the product that possibly is solving a solution to a problem out there in the market. So for us, again, having someone that can build that in-house is super important. Serial founder, it's a little bit unfair, to be honest, but it helps a lot if you guys had some previous experience. Building a company is very difficult. I always have huge respect for people that decided to do that. It's extremely courageous, to be honest, and honestly, I have huge respect. But there's just so many different things that you need to take care of, so many things that don't really work. You have to learn. You can't really read a book and learn how to do things. It's you making mistakes, learning from them, and moving forward. So for investors, it doesn't matter, if your business failed or you had like a small exit or something like that. Obviously, if you were able to return, 300 million to, Sequoia on index, yes, you will be given a check for any round you want to have. But in general, just because you've done something before, it means that you went through that learning curve, and the mistakes you're going to do with your next startups probably will be smaller and less impactful. So that's why it helps a lot for us if we know that there is a serial entrepreneur in front of us. Again, a little bit unfair, but first-time founders, they probably are going through rounds that are a bit more expensive for them, because you have to prove a lot. You have to make us feeling super confident that you can deliver. You have to show lots of leadership, that you have like good clarity on the product, on the market you are in. You need to prove that you are able to position your product in the right way, that yes, there is a competition out there, but you are able to navigate this in a way that will allow you to build some initial traction. So again, it's yeah, it's a little bit complex, but yeah, first-time entrepreneurs, they do have to probably try a little bit harder. More when it comes to the experience, yeah, it helps. It helps if you have seen some interesting technologies, if you are exposed to the problem you are trying to solve. I guess it's not a must, because when you speak with investors, they will be asking you many different questions. So if you know your domain very well, if you've done your homework, and if you can build that confidence on the other side of the table, I think it's not a requirement that you know, the stuff that you are doing is I don't know, maybe a novelty or something that you will be discovering.
So I'm going to ask one last question, and then we'll go to questions from the audience. If you are wanting to do a pitch, can you DM either myself or Purdy? Because if there isn't anyone who wants to go, we have loads of questions from founders, so we'll just use all the time for that. But of course, we'd love to have a few live pitches as well. So before we go to that, Karolina, do you ever do outreach to startups who you're potentially interested in investing in? Like, do you approach them, or does everyone approach you?
So, and InReach, because we have that technology that is surfacing for us these interesting companies, we do the cold outreach. We just send an email with a small invitation that, you know, like we've come across the stuff that you do, we find this interesting, and if the timing is right, we would love to we would love to arrange a call. So we do cold outreach a lot. I think InReach, with regard to the rest of seed stage VCs, hasn't been doing so much PR. We were always a little bit on the side, and yes, we do have inbound, but I think in most of the cases we do cold outreach to entrepreneurs.
So what can founders do? Obviously, your outreach strategy is guided by the technology that you have supporting your firm. But I guess for other VCs, what can startups do to get the attention of VCs? Maybe if they're thinking, they know they're going to raise in 6 months and they want to start generating investor interest, what's the best way to create a little bit of FOMO before they go about doing direct outreach?
Yeah, so I think LinkedIn helps a lot, to be honest. And if you go after something very, very specific, I don't want to kind of, say that do social selling, because we investors are not buying, but it helps a lot if you can produce some relevant content about the stuff that you do. If you can position yourself as an expert. Because some of us, we do screen categories, we do screen spaces, and if someone is doing a great job on LinkedIn, and I think investors do spend lots of time over there, they might, like follow certain hashtags and things like that, that allows them to actually discover certain companies. But I think relevant content is something that I guess you guys will be doing for your customers. And if you just very good with LinkedIn, investors, I think they will notice this and will try to connect with you.
The content is something that we've been hearing from a lot of investors and other founders that have come in to talk. Okay, we're going to do questions from our founders now, and then in about 10 minutes or so, we will move on to pitches. And Tim, you're going to be the first person to pitch, so make sure your deck is ready. Okay, question from Sashin. For B2B SaaS startup seeking its seed round, will letters of intent from well-known companies count as much as MRR?
No. Sorry. I think for us it's quite important to see that someone was able to pay. And you might not have the right customer, but it's just a proof that I don't know, that you've been able to sell it because you have the right process. They might churn in 6 months because yeah, maybe you were too good in selling, but and you promise something that is not really solving the problem. But it does help us a lot that you know that you actually have someone out there willing to say yes and send you money for it. Yeah.
Okay. Ewan wants to know, does your firm deploy cash into a European startup that has incorporated as a D Corp?
Sorry.
Or a Delaware Corp? So if they're
But
incorporated,
what's the question? I didn't hear.
would you invest in a UK startup who also is a American, who's registered in America as well?
Yeah, totally. Yeah. Even though I said, you know, like geography, it's important for us, and we do like Europe. We do have some companies that decided to incorporate in US because it was easier for them, and because maybe they were trying to attract US investor. And I think it's very typical if you have someone from US, they do feel very comfortable with American jurisdiction, and they do like to have things incorporated in US. But yeah, for us, I think the most important is like, okay, you are a European startup, not because where you are incorporated, but you are starting from here. This is where your customer base is. This is where we as investors can help. So the incorporation, it doesn't matter too much. There will be maybe a question mark if you decided to have your startup, I don't know, in Romania or Lithuania, or I don't know, places that maybe are not so popular. Not because, you know, we are against Romania or Lithuania. We are not. These countries have really interesting startup ecosystem, but again, it's so much about your future rounds. So we do help companies to incorporate businesses in places that other investors find comfortable to invest in, because there are different laws, there are different regulations that are more known to investors. And because of that, very often they do like to see, for example, companies incorporated in US, in UK. And if you think, I don't know, if you want to do, for example, Y Combinator or different accelerators that are from US, they will, for example, force you even to incorporate in US, because this is how investors prefer to work with.
Okay. By the way, Francesco, I saw that you had your hand raised earlier. So if you'd like to come on and ask a question live, then just raise your hand again. Okay, now I'm going to take a question from Maya. What other growth metrics do you look for other than MRR in B2B SaaS startups?
So churn, definitely. And then, yes, there is this benchmark that is 10K as a bit of a minimum. But having said that, it's also, you know, the growth. So if you can show us that in the last 6 months, so you've been able to grow the business, then obviously this is an amazing data point for us. At pre-seed, it doesn't happen as often because yeah, there's just so many different unknowns and so many different things that you need to test. You need to create your assumptions, and then for all of this you need resources. But yes, if you can show investors that you've been able to grow consistently your business in the last 6 months, maybe you are just, you know, on a positive trend. So it's great if you have 10% as minimum, but if it doesn't happen because for so many different reasons, I think showing the trend is just something that investors would like to see.
Okay. Francisco, go ahead.
Hi, Karolina. Thank you for the insights. I just have got a question, and I'm trying not to be too technical. Apologies, probably for your CTO. We've got a proprietary AI algorithm that we use, a computer vision machine learning created in-house by myself and my CTO. Is the assessment of the uniqueness of the computer vision algorithm part of your sort of platform, your tech assessment on I guess, your decision making in investment decision for a company such as mine?
Yeah, so when we have a technical company, we do bring into the process Ben, who's our CTO, and it's not like, you know, we will try to rank how good you are in terms of the tech, but we would really try to have a conversation. How do you think about, you know, solving the problem? We will try to, you know, understand what is the architecture that you have, because there is like many different ways how you can set up things, and I don't want to be, for example, like super negative about some languages out there, but if your choice is for example with I don't know, for example, .NET, this is something that is used in enterprises a lot. And it's not like, again, we're like super negative about this, but it will make it difficult for you to attract the right talent. So we do tend to ask about all of these details, just to kind of, you know, put our head around what was your motivation to do all of this? What was your motivation to use certain technologies, to have certain architecture, just kind of, you know, to figure out how you prioritize things, how you structurize things, because there's a lot of things that, you know, you guys take into consideration, and we just kind of like to learn it from you.
All right,
Thank you.
Okay, question from Leonie, and then Tim, we're going to start the pitches off with you, so be ready in like 2 minutes. Leonie asked, how do investors view a bridge round between pre-seed and seed? Is there kind of a negative perception? And if so, how can founders best, you know, best pitch investors on bridge rounds?
Yeah, bridge rounds are interesting, to be honest, and they're not easy, because you don't want to have a bridge round with equity. By this I mean you don't want to have valuation on your bridge rounds, because they might be too expensive. So you always should go for a convertible note, and if you know, if you guys have some questions on that topic, I can obviously dive into it. But bridge rounds are normally happening when you're missing something. It's really to extend your runway. So maybe you are not there in terms of your monthly recurring revenue, or maybe your growth is just patchy, and you need some additional months to be a bit more consistent, because investors, they just maybe don't have the same confidence on their side as you have with your business. So you just need to give them additional data points. So this is why you do the bridge round. And I guess, you know, if I was in my shoes, if I was missing, you know, those few things, I would rather go with the bridge rather than through a very painful and maybe unsuccessful fundraising process. So in most of the cases, the bridge rounds are done by your current investors. It is in their interest to extend your runway and to give you the best chance you can have for the next fundraising. And again, very often they are done with a convertible note. Why it's difficult for external investors to participate? They look at the business, they look at all the data points, and there's like, normally it's like, okay, this is what I'm missing, this and this and this, that's the risk of this business failing. I prefer to wait. And this is typical answer. for to founders when they do bridge rounds. Sometimes when something is like, I don't know, really hot, or investors are like really keen to make a bet in the space, external investors might give you that cash. But in most of the cases, it's going to be your current investors that will help you to extend the runway and prepare you to do the next fundraising in the most successful